Okay. So this particular PowerPoint slideshow is about learning objective 3 in chapter 1. And even though there are 4 financial statements that they introduce you to, we're going to be focused on the first 3 financial statements in this course. We will do the 4th one in Accounting 102 and in Managerial Accounting again. And that's because it's a bit more complex and you need to have a few things sink in before it makes some sense. But anyway, the income statement is listed first. The income statement tells us whether the company is profitable or not for a period of time. The periods of time are always the same. They're either for a month, they're either for a quarter, which is a 3-month period. A quarter means a quarter of a year. And since there's 12 months to a year, a quarter of a year is 3 months. So the quarter or the year. We only measure financial information for profit and loss for those 3 periods of time: month, quarter, and year. Okay. So every month we'll be calculating whether a company is profitable or not. A 3-month period taken as a big piece is a quarterly statement. That's what you hear about a lot on financial news is quarterly reports. And then, of course, at the end of a 12-month period of time, they tell you how their year went, okay, in terms of whether they had a profitable year or the year ended in a loss. Now, again, the most important thing to understand when it comes to the income statement is that it's always the very, very first financial statement that we prepare, because the owners want to know, did we make a profit or a loss this month, this quarter, this year? That's the premier question owners always have, okay? And we will look into that statement in detail. Once we determine whether the company made a profit or a loss, and just a kind of a warning, this is a very happy book, wonderful book it is. The first few chapters of this book, all of the companies are profitable, every single one. It's a wonderful life. And so you're not going to see a company that had a loss for a little while. But in a reality, of course, a lot of companies do experience losses and do not have profits. But in our world, Accounting 101 world, all of the companies are going to be profitable. So you are going to be very, very fortunate. Well, profit on the income statement is called net income. There are some terms that are interchangeable that you kind of need to know. Net income and profit mean the same, okay? But also the word earnings means profit as well. So you have 3 terms that mean the exact same thing. Net income means profit, profit means earnings, earnings means net income, blah, blah, blah. Okay, so these 3 terms are thrown around in financial circles. They mean the same thing. Okay, was the company profitable? So once you determine on the income statement a company has a profit, the question then becomes, well, how much of the profit are you going to keep in the company? Right. How much of that profit are you going to keep in the company? So to keep something in is to retain it. So these 2 words, retained, which means keeping in, and earnings, which means profits, you can see the retained earnings statement tells us how much of the profit they're keeping in the company. Well, what else can happen to a profit of a company? Well, sometimes the profit of the company is shared with the owners in the form of a dividend. So you probably read the word dividend. A dividend simply is when a company shares a portion of its profits with the owners. Now, in this case, the owners, because we're focusing on the corporate form, are stockholders. And so this is usually cash being sent out of the company, directly to the owner's personal accounts. And so it's deducted from the retained earnings because it's not being kept in, it's not being retained, it's actually being sent out. So those are the only two things. The rest of these profits, the company wants to use to be more profitable in the future, which means they're going to be purchasing more assets. So if I were a pizzeria and I made a big profit for the year, I would want to retain as much of those profits as possible. But then once I do have this amount of profit that I'm retaining, what do I do with it? Well, that's where the investing activities come up in Learning Objective 2. I would want to use that money to buy assets that help me sell more pizza. Remember, I'm a pizzeria. So I want to use all that money, as much of it as possible, to buy assets to increase my sales of pizza and whatever products I offer. And so perhaps buying a new efficient oven that can cook 10 pizzas in 10 minutes versus one that I have now, which only can cook 5 pizzas in 10 minutes. Well, I can double the amount of pizza I can sell, technically. So that means that it's an investing activity. I would want to use my retained earnings, retained profits, to perhaps update my ovens and put out more product. I could also purchase a delivery truck, because if I purchased a delivery truck now, I could drive pizzas to people's homes and sell more pizza that way, because people might not want to come out to my store, but they're more than happy to pick up the phone and say, yeah, give me a pizza. Come on, deliver a pizza to me. So perhaps purchasing a delivery truck might be a good way to use my retained profits, because that way I can sell more of my pizza. Advertising is not a good way to look at how you use retained earnings. It's not an investing activity. It's an expense. If you look at any type of financial statement, you'll see advertising expenses listed on the income statement. Expenses are not the same as investing activities because they don't add to your assets. And they don't, even if you did buy a bunch of advertising and send coupons to everybody in your neighborhood, it's really hard to track whether that actually resulted in more sales. There's an old adage in the advertising industry for advertising executives to say that we know we're wasting half of our advertising money. We just can't tell you which half we're wasting. And that just says it all. They know that it has some effect, but they just don't know how to measure it. They just can't measure it. And so we can't see an advertising expense as a way to use retained earnings. It's just not. It's not an investing activity because it doesn't add to your assets. It doesn't add to directly related sales of your business, whatever your business is doing. And the very last statement that we do is a balance sheet. Now, before I get to the balance sheet, I do want to make sure you understand that both the income statement and the retained earnings statement measure the same period of time. So if the income statement is for the month of September, the retained earnings statement is also for the month of September. If the income statement is for the year 2019, then the retained earnings statement is also for the year 2019. And that's because we have to find out what the profit is, which means we have to do an income statement first to tell the story of how much of that profit was retained. So the retained earnings statement is directly dependent on the income statement. The income statement has to be done first to tell everyone whether we had a profit or not. Then the retained earnings statement tells us what happened to that profit. How much of that profit was retained? how much of that profit was sent out in the form of a dividend. So it's always the second statement that's done, but it matches the period of time exact to the income statement. The reason I bring that up is because the balance sheet is only for the day that we're doing it. The balance sheet shows the company's assets, liabilities, and stockholders' equity for a given day. So a balance sheet is sort of like a financial selfie. And you all kind of know, you probably all take a selfie at one point in time. Well, a balance sheet is basically a financial selfie of the company that day. This is what our assets are today. This is what our liabilities are today. That is the phone, you know, the camera on the phone. My sound effects aren't as good, but I'm working on it. And this is our stockholders' equity today. Okay, so there we go. That's basically a balance sheet is going to have one date on it, the date that you actually do it, and that's it. That's different than an income statement, a retained earnings statement, measure periods of time, a month, a quarter, a year. Balance sheets only for the day. Okay, so that's an important distinction. And the statement of cash flow we will do in Accounting 102 and managerial accounting. Okay, very, very important to understand that there are only two types of accounts that go on an income statement. An income statement measures profit and loss. Now, again, the formal word for a profit or earnings is net income. Net income basically is a profit for a company. Notice that this particular income statement is for the month of October, right? So that means everything that happened from October the 1st to October 31st, 2017 is reflected on this statement. Income statement measures how much we've sold to customers, okay, of what we do. Now, this particular company, Sierra Corporation, in the book, if you've read through, it's just simply a fictitious company that does tours, you know, around the Sierra Nevada area in California. And so when you go to Sierra Corporation, you're actually purchasing a tour, a hiking tour. And that's what's set up. So the revenue means, in this case, how much money did we collect from customers by selling our tours? And so revenue is all about what we are collecting from customers for selling our goods or services. Now, in this case, it's a service that Sierra Corporation is providing. A service is when you pay someone to do work for you. That's different than going to Walmart and buying goods off the shelf. That's called sales revenue. You'll see sales revenue coming up in chapter 5 when we get to merchandising. But just for you to know, service revenue, the word service is when you're paying someone to do something for you. So whether that's taking you on a tour, cleaning your house, cutting your hair, providing legal services for you, providing counseling services for you, you're paying someone to provide a service. And so companies that, and most companies are in the service industry, okay? We are, I even work for a service-based company. Education is a service-based company. We're providing a service. And many of you probably have worked or are working for service-based companies. You're providing a service to someone else. And so this is very common. There are some companies that do both. They sell products and they sell services. So for example, if you went to have your tires changed on your car, you're doing both. You're paying for the actual tires themselves. Those would be sales revenue because you're purchasing a good product. And you're also purchasing the services. They're going to take your old tires off. They're going to put the new tires on. They're going to, fix it all up for you. That's a service. You're paying them to do work for you. So you're going to have companies that have two different types of revenue streams, mostly, one from providing services, the other from selling goods. In the very first 4 chapters of this book, the emphasis is on services. Expenses are another category on the income statement. Expenses are all the costs that you had, that in this case, Sierra Corporation had to incur in the month of October to provide those tours to their customers. Okay. And so as you notice here, there are many different types of expenses that are listed. Okay. There are 6 here specifically. It's very important to know that each of these 6 expenses are specific expense accounts. So expenses are a general category of account, but everything that you see here, from salaries all the way down to insurance, these are specific names of accounts. Now, let me give you some very, very good advice that no one has ever shared with anybody else before outside of my class. In order, and this is just so much wisdom being poured out right now, I think I might need a drink. But in order to understand accounting, right, the root word of accounting is account. So in order to understand accounting, you need to understand the accounts. Okay. You understand those accounts and what they mean, you're going to understand accounting because it's the root of the word. So for example, revenues and expenses are broad categories of accounts. Revenues is, again, what we're selling to our customers in terms of services and goods. Expenses, again, broad category, all the money we have to spend, in this case, this month, to generate all that revenue. Well, specific revenue account, service revenue, tells you specifically, right, that they sold services to raise money from customers. Okay. They sold services to customers to get that money. The same thing if there was another revenue account called sales revenue, because they sold goods to customers like Walmart does. That would be a specific revenue account. It tells you exactly what you need to know about their revenue, how they raised money from customers by selling stuff to them. Well, each of these 6 expenses are individual expenses. You have to label your costs based on what it is. In accounting, you have to be as specific as humanly possible. I'm not a big fan of miscellaneous expense because it has to be something. It has to be something. You can't label it. You have to label it for what it is. So salaries and wages expense is a specific name of an expense account. And you have to know what that is. That means that Sierra Corporation spent $5,200 on salaries and wages for the month of October, so its employees can provide tours to the customer. Okay. That's specifically what salaries and wages expense is. Okay. Rent expense, now, this might surprise a lot of people, maybe it doesn't, but most businesses rent their space. Most businesses do not own the buildings. There are some businesses that do. So Walmart tends to own their buildings. McDonald's, Wendy's, those companies tend to own their buildings. However, most stores don't own their buildings. They rent from a landlord. The biggest example I can give you this is the mall. The mall is owned by a real estate company, and they basically lease the space inside the mall to all the businesses that you and I shop in. And so when you go to the mall, every single store in the mall is paying rent to be there. And so for the month of October, our company here, Sierra Corporation, paid $900 for rent to keep their business open for October. So that becomes a rent expense. That becomes a rent expense. And so again, each particular expense account is listed and very important to sort of understand, okay? And again, you'll get to know a little bit more about each of these expenses over time. So on the far right side of the statement, you have the totals. $10,600 are the total revenue for the month of October. The $7,740 is the total of all of these, all of these 6 expenses added up. So you took in $10,600 from customers and giving them tours. You had to use $7,740 of that to cover the expenses for the month of October. The remaining portion of it is your profit. Again, profit and net income mean the same thing. Earnings and net income mean the same thing. Profit and earnings mean the same thing, okay? Interchangeable terms. So your $2,860 profit is the profit for October. Profits occur when your revenue, how much you sell, is greater than your expenses. Now, like I told you, this is a very happy book. All the companies are profitable. However, there are some companies that, as you know, particularly in the last several months since the crisis has started, they haven't had a lot of customers come in, and so their revenue is very small. But they still have to pay their rent. They still have to pay their expenses. And so they've ended up with what we call a net loss. A net loss simply is your expenses are bigger than the revenue for the period of time, the month, the quarter, the year. And you can only sustain a net loss for a period of time, okay? And so it's up to the owners. Just like if you had a small business and you lost money this month, only you can decide whether you're going to continue, right? And the only way you continue is you need to cover the loss and have enough money to do that and move forward. Corporations are no different, okay? So who owns the profit? So in this case, Sierra Corporation, excuse me, had a $2,860 profit this month for October. Whose profit is it? Well, it's the owner's profit. Who are the owners of a corporation? Stockholders. So the profits of a company belong to the owners. And whether that's you're a small business, you're a sole proprietor, you're the only owner, you make a profit, it's all yours, no question. In a partnership, if you have an equal partnership with someone, you make a profit, half of that profit is yours, you own half of it, and the other person owns the other half, right? In our example. Well, for a corporation, the profit is owned by the owners. And in this case, the owners are stockholders. And there are many, many, many stockholders. When you incorporate, the state is recognizing your ownership is broken into so many shares of ownership. And so technically you could have as little as 200 owners in the state of New York. You could have 200 million owners. It's up to you, really, when you control a corporation, how many shares of ownership you want to break your company into legally. Okay, so this particular profit belongs to the owners. Well, if you were the owner of Sierra Corporation, this is your first month doing business, and you made a profit of $2,860, what would you want to do with it? Well, for the most part, a lot of people would say, we want to keep as much of that profit in the business. So again, to keep something in is to retain. Okay. And so in this case, we want to keep or retain as much of that profit in the company as possible. Well, what else can happen to the profit? Well, the other thing that can happen to the profit is some of the profit can be shared with the owners in the form of a dividend. And so dividends are simply a portion of the profit that is sent directly out of the company to the stockholder's personal account. So that's why it's subtracted out of the retained earnings statement, because literally it is going out of the company. It's no longer retained, it's going out. And so the difference in this case, this $2,360 in our example here, is the retained earnings at the end of the month. In other words, the amount of this profit that they made that's going to be retained, kept in the company, not sent away. Okay. So this retained earnings becomes a very important account, because retained earnings is a stockholder's equity account, because it shows everyone how much of the profits of the company have been retained over time. That's all it really tells us. It's a very simple statement. Net income gets added in, dividends get subtracted out. That's really all that happens on a retained earnings statement. As such, it is a relatively simple statement to prepare, and it doesn't have as much emphasis or as much importance as the income statement. Notice too, as I mentioned to you earlier, is that both statements are for the exact same period of time, because you have to calculate the profit before you can tell us how much of profit is going to be retained. So you have to calculate, you have to do the income statement first. It's always the first statement done before you can go ahead and do a retained earnings statement, because the retained earnings statement is based on the answer to your income statement. So no income statement, no retained earnings statement, can't do it. So you have to do it in that order. Retained earnings, again, the account is a stockholder's equity account because the profits belong to the owners. So you're going to see the retained earnings balance show up on the balance sheet under stockholders' equity, because it's the stockholders, the owners, that own the profits retained in the company. So there are actually two stockholders' equity accounts that you need to be familiar with. The first one, it was mentioned earlier on, called common stock. And common stock simply is when you start a company, you put cash into the company. In exchange for that cash, you get a piece of the ownership. And again, in a corporate form, ownership is represented by shares of ownership. Shares of ownership is what we call common stock. Stock and shares of ownership mean the exact same thing. Shares, stock, same thing. So those are also interchangeable terms. Retained earnings, as we mentioned, is the profit of the owners being retained, kept in. So if this is the profit of the owners, we have to show it as owner's property, and that's why it's listed here under stockholders' equity. Okay. So that's how those statements are connected. Also notice, as I mentioned earlier, the balance sheet is a selfie. It only tells you what's happening on that particular day. And there are, balance sheets always start with the assets of the company. Assets of the company are the resources that are owned by the company. And they use those resources usually to sell their products or services, whatever type of business that they're in. These are very specific asset accounts that you have to be familiar with. The cash account, for example, is simply their main banking accounts where all of their, where they keep their cash, basically. So you and I, if we had a balance sheet and we had a cash account, we would look at basically all of our bank accounts and say, okay, this is how much cash I have. It's important to understand that you need to have an idea of what all these accounts are really about, because in accounting, assets are a general category of account, but cash is a specific account. That's an asset account. So you have to know the specific accounts. Again, the root of accounting is account. And if you want to know accounting, you need to know the account, each individual account. Accounts receivable happens when a business usually sells to another business some products, and they say, look, you can pay me later. We'll wait to receive payment. That's an accounts receivable. They're waiting to receive payment. Equipment, for example, is a long-term asset. Usually when you're buying equipment for any business, you're buying it for a longer period of time. And so what you'll learn in chapter 2, coming up soon, is that we classify assets in terms of short-term and long-term use. Short-term use of an asset is something that we're going to exhaust within a year. Long-term assets are assets in which we're going to be using for longer than 1 year. So when you're buying equipment, you're usually going to be buying equipment and using it for much longer than a year. Let me go back to my pizzeria, for example. If I bought a new oven for my pizzeria, that oven is going to be lasting me maybe 10, 15 years. So it would be considered equipment on my balance sheet. If I bought a delivery truck for my pizzeria because I wanted to drive it and deliver pizzas directly to people's homes, I might say because that truck's probably going to get a lot of miles on it, I'm probably going to use it for, say, 5 years. At least that's the hope. Well, that's also going to be a long-term asset. It'll show up on the balance sheet as something that's longer term. Trucks can also be considered equipment. In this book, they use it as vehicles or equipment, but in reality, there's actually specific vehicle accounts. And so that's how we set this up. Assets are totaled. In this case, for Sierra Corporation, we have $21,910 of assets in total. That's all these assets added together. Okay. Well, if you have $21,910 of assets, you're going to need to balance it out on the other side with liabilities and your stockholders' equity accounts. Liabilities are simply debts. Any type of debt that you owe is a liability. If you owe it, it would be here. Just a couple of accounts I'll go over. So liability is a general form of account, just like assets are. But these are specific accounts. So notes payable is a specific account. That's a liability account. Accounts payable is also a specific account. That's a liability account. So a note is a loan. And a loan means it has an interest rate attached to it and a due date. And so notes payable are basically loans payable. You usually pay the whole thing when it's due. So a note payable, unlike most loans, you and I are used to saying, oh, a loan, so I have this monthly payment. No. In a business, a note payable is a loan that you pay on its due date with the interest all at once. And so it's going to be listed there in full. An account payable is simply a bill that's due within 30 days. It's not a loan, so it's not a note. So if you get a bill from the electric company, and we all do, and we owe $100 to Central Hudson, well, that $100 becomes an accounts payable because you're going to pay it within 30 days. There's no interest attached to it, so it's not a loan, so it's not a note. It's an accounts payable simply because you owe it. Now that you got the bill, you owe it. Before you got the bill, you didn't owe it, so it wouldn't be on the balance sheet. But as soon as you got that bill and you opened it and say, shit, I owe $100 for electric, now it becomes an accounts payable. Okay. One other account I'll go over here because I think it's important. Unearned service revenue is a very common account. Any unearned revenue means that the customer has paid you up front. And that's why you owe the customer whatever they paid for. Remember, liabilities are about owing if you owe anything. So when a customer pays you up front, you owe the customer for what they paid. That's why it's a liability. And this is a very common account. A lot of people don't realize how common this account is. I know a lot of people aren't traveling or going to sporting events these days because of COVID. But let's say you booked a vacation to Disney. Not that I would recommend it, but so you purchased airplane tickets. You purchased several days down at a Disney hotel, and you purchased passes to the parks. Okay, well, how do the companies look at the money that you paid them? You're not going for a few months. Say it's a Thanksgiving vacation or a Christmas vacation. Well, you just paid for an airline for a flight that hasn't happened yet. So the company cannot say that they earned that, so it's not revenue. The company has to list it on its liabilities as unearned revenue, unearned, in this case, unearned ticket revenue. And the airline says, well, we owe a flight to Florida to person A and person B. Same thing, when you purchase that hotel, you pay for it up front because it's a good deal. You're giving your money up front. They owe you a stay at the hotel. They can't say it's their money. So that goes into unearned revenue. Same thing when you buy passes for the Disney parks up front. It's unearned revenue. They owe you a day or two, whatever amount of days you bought on your passes. They owe you that. So they can't say it's theirs until they've earned it. And that's important. Revenue is earned, which means the work has been done. Unearned revenue means that we haven't earned the revenue. The customer has paid us, but we haven't earned what they paid us for. We owe the customer for what they paid. That's why it's on the liability list. And it's a very, very important liability to understand. It's much more common than a lot of people think. Even if you purchase tickets to go to a concert and the concert's not till November, well, you're buying your tickets now. How does the company handle the fact they got all this cash up front? Well, they're going to say they owe these people a concert or owe them a ball game, right? If you buy tickets up front to a season, whether it's football, baseball, what have you, that money that's being collected is a liability. They owe you a game or a set of games, whatever you paid for. So it's a very, again, it seems like an odd account to be in there, but it is something that's extremely important and very, very common in a lot of businesses. And we just went over our stockholders' equity accounts earlier. Notice that we have total liabilities listed and total stockholders' equity listed separate. And then they're totaled up to make sure that they equal our total assets. Total assets must equal our total liabilities and stockholders' equity. This we call the balance sheet equation or the accounting equation. And this is something that you're going to get to know quite well. Okay, assets equals liabilities and stockholders' equity. It's called a balance sheet because they have to balance. Assets are on one side, they must equal these two on the other side, okay? And that's just something that's extremely important to remember. Okay, so I'm gonna go ahead and do a couple of things. I'm gonna stop the share. And ask if there's any particular questions on what we just went over.